News reporter, and I'm Sheila G. Bataan. So first, let's define tax incentives. It is a government measure that is intended to encourage individuals and businesses to spend money or to save money by reducing the amount of tax that they have to pay. These incentives are typically offered to individuals, businesses, or organizations to promote desired outcomes that align with the government's economic, social, or environmental objectives. So next, tax incentive can take various forms. It includes investment incentives, tax deduction, tax exemptions, tax credits, tax holidays, tax deferrals, and lastly, reduced tax rates. First, investment incentives are initiatives or programs implemented by governments or organizations to encourage and attract investments in a particular region or industry. For example, the government offers 10-year corporate income tax holiday for companies investing in renewable energy projects. This means that companies will be exempt from paying corporate income tax for 10 years. Next, tax deduction are expenses or allowance that can be subtracted from taxpayers' total income, reducing the amount of taxable income and consequently the tax liability. Example, business expense, home mortgage interest, medical expense, education expense, charitable contribution, and many more. Exemption refers to a legal provision that allows certain individual, organizations, or activities to be excluded or exempted from paying taxes on specific types of income, property, or transactions. For example, let's say there's a country that offers tax exemptions for charitable organization. In this case, a non-profit organization that is registered as a charitable entity may be eligible for tax exemptions. So next, let's go to tax credits. Are provision in a tax code that directly reduce the amount of tax owed by individual or business. Example, a research and development tax credit can provide a percentage reduction in tax liability for eligible R&D expense. So let's go to tax holidays, are temporary periods during which specific taxes are reduced or eliminated altogether. These holidays are often targeted at attracting investment in particular industries or regions. For example, a government might declare a tax holiday for new businesses established in designated economic zone. So let's go in tax deferrals. Allow taxpayers to postpone paying taxes on certain income or gains until a later date. This can provide business with temporary cash flow benefits, especially in situation when the income is reinvested or held in reserve. May offer reduced tax rates for specific activities or industries to promote growth and competitiveness. For example, lower tax rate may be applied to income derived from intellectual property or to encourage
Good morning, everyone. I'm Jayan Piliora, and the next topic would be the 4 typical costs for tax incentives. So first, we have resource allocation cost. Second, compliance cost. Third, revenue cost. And the last is corruption cost. So first, let's tackle the resource allocation cost. Resource allocation cost is like when you have a limited amount of money and you need to decide how to spend it wisely. It's about making choice on where to put your resources like money or time. So when the government gives tax breaks, it means they are giving up some of the money they could have collected in taxes. This affects how much money they have to spend on different things like schools, roads, or healthcare. For example, you have 100 pesos to spend and you want to buy snacks and a new toy. If you spend 70 pesos on snacks because there's a discount, you only have 30 pesos left for the toy. That's resource allocation. You've chosen to spend more on snacks, so you have less money left for the toy. Similarly, when the government gives tax breaks to encourage buying electric cars, they collect less money in taxes. This means there's less money available for things like better roads or improving public transportation. So resource allocation cost is about deciding where to spend money and understanding that giving tax breaks in one area means there's less money available for other things. Next, we have compliance cost. It's like the effort and money you spend to follow the rules or meet certain requirements. It's what you have to do to make sure you are doing things the right way, even if it takes extra time or resources. So, with tax incentives, compliance cost is the extra works and expense businesses or individuals have to go through to make sure they qualify for the tax benefits offered by the governments. So, for example, you are playing a game, but there are special rules you have to follow to win a prize. To follow those rules, you might need to buy specific equipment or expend extra time practicing. Similarly, with tax incentives, businesses might need to hire accountants or spend time gathering paperwork to prove they qualify for the tax breaks. So, compliance cost is like the price you pay to make sure you're playing by the rules and getting the benefits you're entitled to. Next is the revenue cost. So revenue cost is like the money and effort spent by the government to make sure everyone follows the rules when it comes to tax incentives. It's about checking if people who are getting benefits from tax breaks actually deserve them. For example, imagine the government gives a tax breaks to families with kids going to school. To make sure only eligible families get the tax break, the government has to hire people or set up systems to check if families really have kids in schools. This checking process costs money and takes time. So the more families applying for the tax breaks, the more work and money the government needs to spend on checking everything. That's revenue cost because it's the cost of making sure tax incentives are being used fairly. The last one is corruption cost. When someone cheats or plays unfairly in a game, but in real life, especially with money and rules, it happens when people misuse or manipulate system for their own gain, even if it's not fair or allowed. So, with tax incentives, corruption cost is when people find sneaky ways to get the benefits like lying or bending the rules. So for example, if there's a tax incentives for small business to get financial help from the government, but some business owners pretend to be smaller than they actually are or fake their financial records to qualify for the aid, even though they're not really eligible. It's like someone cheating in a race by taking shortcuts or using a faster car. The cost of corruption here is that the government loses money and trust, and honest businesses miss out on help because others are playing unfairly.
Good day everyone, my name is Junroy Damasi and I'm here to discuss to you the incentives under the CREATE law. So incentives under the CREATE law, it reduces corporate income tax rates and additional deductions for qualified expenses. Among other benefits, the law aims to attract investments, create jobs, and boost economic recovery. So incentives under the CREATE law, it reduces corporate income tax rates, additional deductions for certain expenses, enhanced deductions for research and development. So examples of incentives under the CREATE law, it includes lowered corporate income tax rates which gradually reduce over several years, an additional deduction for qualified expenses such as training, research, and development costs. The next topic will be the income tax holiday. So, what is income tax holiday? Income tax holiday is a period during which a company is exempt from paying income taxes. This incentive is often provided by governments to attract investments, stimulate economic growth, and encourage business to establish operations in specific regions or industries. So the example of income tax holiday is a newly established manufacturing company being exempt from income taxes for a certain number of years. An export-oriented enterprise receiving an income tax holiday to boost exports and international trade.
Good day everyone, I am the next reporter, Mr. Kent Marvin of Proc. The topic that I'm going to discuss is subject to certain condition, the additional deduction or enhanced deduction. So here's the list as follows. Number 1 is the precision of qualified capital expenditures. This allows businesses to deduct a portion of a cost of acquiring property, plant, and equipment each year. The depreciation varies depending on the type of asset. The list of a 10% depreciation rate for buildings and a 20% rate for machinery and equipment. For example, a company buy a new factory equipment worth of 100,000 pesos under the standard depreciation rules. They might be spread this deduction out over 5 years, 20% per year. With an enhanced deduction, they could deduct a larger chunk like 20,000 pesos with a 20% in the first year itself. The second one is labor expenses. Businesses can deduct a percentage of their labor expenses, which includes salaries, wages, and benefits paid to employees. The image shows an enhanced deduction of 50% for labor expenses. In example, a company with a total salary expense of 1 million could deduct the usual amount under regular rules. With a 50% enhanced deduction, they could potentially deduct an additional 500,000 pesos, lowering their taxable income. And the third one is research and development expense or R&D. Businesses can deduct a percentage of their R&D expenses. This shows an enhanced deduction of 100% for R&D expenses. And the example is a company spends 200,000 on developing a new product. Normally, they might be able to deduct a portion of this as an expense with a 100% enhanced deduction. They could deduct the entire 200,000, significantly reducing their taxable income. And the fourth one is training expense. Businesses can deduct a percentage of their training expenses for their employees. The shows an enhanced deduction of 100% for training expenses. An example, a company spends 50,000 pesos on employees training program. Under normal rules, they could deduct a part of it. With a 100% enhanced deduction, they could deduct an entire 50,000, lessening their taxable burden. And the fifth one is domestic input expense. Businesses can deduct a percentage of the cost of goods manufactured or purchases locally. The image shows an enhanced deduction of 50% for domestic input expenses. An example, a company that manufactures furniture incurs 800,000 pesos in cost for local wood and other materials regularly. They might be deduct a part of this with a 50% enhanced deduction. They could potentially deduct an enhanced 400,000 pesos, lowering their taxable income. And the sixth one is power expense. Businesses can deduct a percentage of their expenses for electricity and other forms of power. The image shows an enhanced deduction of 50% for power expenses. In the example, factory spends 300,000 pesos in electricity each month. Normally, they could deduct a portion of this expense with a 50% enhanced deduction. They might be deduct an additional 150,000 monthly, reducing their taxable income over time. And the seventh is reinvestment allowance for the manufacturing industry. Businesses in the manufacturing industry can deduct a portion of profits they reinvest in the business. The image shows a maximum deduction of a 50% over a 5-year period. For example, a manufacturing company makes a profit of 1 million and decide to reinvest 500,000 pesos in a buying equipment. Under the reinvestment allowance, they might be able to deduct a portion of reinvested amount up to 50% from their taxable income over the next 5 years. And the last one is net operating loss or renewal. This occurs when a business has expense that exceed its incomes in a particular year, resulting in a loss. carry over. This provision allows businesses to carry over their net operating loss from the first 3 years of the commercial operation. They can then use this NOL to reduce their taxable income in the following 5 consecutive years. In a simple terms, if a new business makes a loss in the first 3 years, which in common for startup, they can deduct the loss from their taxable income in the following 5 years. This helps to offset their tax burden during the crucial years. For the conclusion of my topic, these incentives are typically targeted towards specific sectors or activities such as research and development, renewable energy, small businesses, or foreign investment. So that's all of my report. Thank you.
Good day, everyone. I am Enamio Lagak. I am the next reporter. Number 3 is a custom duty exception for importations of capital equipment, raw materials as part of accessories. 4 is a VAT exception on importation and a VAT 0 rating on domestic purchases. Number 5 is the additional 2 years ITH shall be granted to project or activities registered enterprises located in areas recovering armed conflict or a major disaster. Number 6 is the additional 3 years ITH shall be granted to project or activities of registered entities prior to effectivity of CREATE, or under the incentive system when such as entities relocate from the National Capital Region and NCR. For a second classification, the ITH period shall be only commences at the completion of the relocation of operations.
The period of adjournment shall commence from the actual start commercial operation with a registered business enterprise availing of tax incentives within 3 years from the date of registration unless otherwise provided in the SIPP. Qualified expansion or entirely new project or activity may qualify to avail incentive subject to qualification in the IPP and performance review by the Fiscal Incentives Review Board.
Good morning, ma'am. Good morning, classmate. I am Jolito Casin. I will continue the report about tax incentives. Entities that are registered with the Investment Promotion Agencies, IPAs, that are still enjoying incentives prior to the effectivity of the CREATE law will be allowed to continue the said enjoyment, subject to the following rules. Those granted only an ITH prior to the effectivity of CREATE shall be allowed to continue with their availment for the remaining period. Those that have been granted the ITH but have not yet availed of the incentive upon the effectively CREATE may use the ITH for the period specified in the terms and conditions of their registration. Those granted ITH prior to effectively of CREATE and entitled to 5% tax on gross income earned after the ITH shall be allowed to continue to avail of the 5% gross earned income incentive for 10 years. Those availing of the 5% tax on gross earned income prior the effectively of CREATE shall be allowed to continue availing the said incentive for 10 years.
Economic stimulus. Thus, tax incentives can encourage economic growth by promoting specific activities such investing in a certain industry or region. Example, an economic stimulus measure is a government reducing interest rate to encourage borrowing and investment, thus in stimulating economic activity. Another example is a direct cash payment to individual business to increase spending, demanding income. Behavior modification. Government use
tax incentives to influence individual and corporate behavior. Example, behavior modification is using positive reinforcement such as a reward or praise to encourage a desired behavior. For instance, a parents might give their child a sticker every time they complete their homework on the reinforced behavior of being diligent with their studies. Why does the government implement tax incentives? Government implement tax incentive to encourage certain behavior or outcomes that they deem beneficially for the economy, society, or specific industries. By offering tax breaks or credit, the government aims to individual and business to engage in activities such as investing, spending, innovation, and job creation. Example, let's say government wants to promote the use of electric vehicles to reduce carbon emission and dependency fossil fuel. They could implement tax incentives such as tax credit or rebates for purchasing EVs by reducing the cost of buying electric vehicles through tax breaks. Where the government aims to encourage more people to adopt this environmentally friendly mode of transportation. Let's go.
For the continuation of the topic of how does the government implement tax incentives, or why does the government implement tax incentives, as my co-reporter have already given the first two reasons, which is the economic stimulus and behavior modification. Here's another one. This is what we call the investment attraction. So what do you mean by this? For example, charity institutions like PCSO, diba, from our previous topic, charitable institutions like this are tax exempted. But why is it nga magbayad man ang mga winners of tax? That is because the money that they win are taxable as an excise tax, kay nahulog naman siya as gambling. Another example is the importation of goods. Like agricultural supplies, kana sila, it is also a tax exempt. So, do you understand the idea of tax incentives? It can attract the investors by reducing or exempting in the means of tax. So, another reason is another tax incentives are job creation. So, how? The government may subsidize wages. So, of course, ma-encourage ang mga employers to hire more workers, and the benefit of that, well, ma-reduce man lang ang atuang unemployed mga persons or unemployed nga mga employees like that. So, the last reason of government implement tax incentives is to support the specific industries. One example of that is the poverty alleviation. Best example sa kanang poverty alleviation bitaw is the 4Ps program. Another is the PhilHealth to reduce or eradicate poverty. So, another is the competitiveness in our industry. So, ang mga example aning mga competitiveness bitaw is apil na siya ang innovation and research. Kay para mas ma-develop ang atuang mga research institutions, mga inana. So, mana ni siya as it adds competitiveness in our industry. Another is the regional development, like infrastructure development, kanang mga kalsada nato. That is one example of infrastructure development, okay? And of course, the sustainability and social goals.
Conclusion: tax incentives refer to the provision made by governments to encourage certain behaviors or investments by individuals or businesses through the use of tax benefits. These incentives are designed to promote economic growth, attract investment, create jobs, and stimulate specific industry or activities. Tax incentives can take various forms, including tax credits, exemptions, deduction, deferrals, or reduced tax rates. While tax incentives can have positive effect on the economy, they also come with certain costs. 4 typical costs associated with tax incentives include revenue loss for the government, potential distortion in resource allocation, administrative complexities, and potential inequities in tax system. One example of tax incentives is the incentives provided under the CREATE Law, Corporate Recovery and Tax Incentives for Enterprises Act enacted in the Philippines. The CREATE Law aims to lower the corporate income tax rate for businesses and provides additional incentives to attract investments, promote job creation, and enhance competitiveness. Governments implement tax incentives for various reasons. Some of the key motivation includes stimulating economic growth, attracting domestic and foreign investment, encouraging innovation and research, promoting regional development, improving competitiveness in specific industries, and addressing social or environmental objectives. By providing tax incentive, governments seek to influence the behavior to individuals and businesses to achieve these desired outcomes.